So as you're looking at some of this market action ahead of this big day that we're expecting out of Jackson Hole, talk about some of the things that the markets are digesting right now.
Well, thanks for having me. I think we're all sort of on pins and needles as to what Powell might say. I think that expectations for clarity might be a little beyond reality, though. I think we'd all like some clarity from Powell as to where he sees the Fed funds rate peaking, when, and then what impact that is likely to have in the economic scenarios over the next year or so. The likelihood of actually getting that kind of specificity is, I think, pretty low. I think what we really want to hear simply is, how's the Fed looking at the situation now? Are they encouraged by the decline in inflation we've seen? Are they still very worried about inflation? I think that's going to be the message we get from Powell, that they need to get this under control. But the nuances will be important. And then, the title of his speech is about constraints on the economy and the markets from Federal Reserve policy, and just how much can the Fed influence the economy and markets. And I think it'll be interesting to see what he says there, because that may set the stage for some sort of different framework from the Fed than we've seen before.
Well, Kathy, the Fed certainly has a massive challenge, right? Finding a way to cool inflation, trying to do it without damaging the economy. From what we heard in terms of the Fed's playbook up until now, what we will likely hear over the coming months, do you think the Fed is going to be able to walk that thin line, really thread that needle that I think Wall Street is a little bit uncertain about at this point?
Oh, I think it's going to be a real challenge. This is not fine tuning, and I would not say that people at the Fed have a clear vision of a pinpoint of the Fed funds rate or the amount of quantitative tightening to do to achieve that soft landing. Obviously, that's the goal. And it's pretty good situation they're starting from, because unemployment is low. The economy is kind of churning along. It's not falling off a cliff. But the headwinds are, tightening in Europe and other global central banks going into a very risky situation with the energy prospects there. The Bank of England tightening, even though they're forecasting a recession. Slowdown in China. The Fed's going to have to walk a pretty fine line between hiking enough to get inflation down, but not going overboard and sending us into a recession. And that's going to be a real challenge.
How much do you think we'll hear about the balance sheet? We haven't talked about it. We haven't heard about it much. It's been so much focus on the hikes.
Well, I hope we hear a little bit more about it, because there's a lot of question marks around it, particularly their mortgage-backed securities holdings, which they have indicated that they want to bring down. Esther George at the Kansas City Fed actually did make some comments today about it, or yesterday about it, saying that she's taking that into consideration as a part of the tightening program, and that's one reason she hasn't been in favor of more rapid rate hikes, because she's wanting to see what the lagged impact, not only of the rate hikes is, but also that quantitative tightening, which is really just starting to get underway. It's going to pick up steam in September. So I'd love to hear more about the Fed's plans. I'd love to have them say, $1 trillion reduction is worth how many basis points in tightening. I don't think I'll get that clarity, but that would be great to know.
So then, Kathy, what's the play here in terms of fixed income in this sort of environment?
Well, we've been suggesting that so we came into the year saying keep duration low because we knew that we were on a path of higher interest rates. Now that we've gotten to, plus 3% on the 10-year, now we're at a flat to inverted yield curve. Now we're suggesting investors take a look at some longer maturities of high credit quality. So you could look at investment-grade corporate bonds with maturities in the 5 or 6 year area that have yields north of 4%. That's pretty good when you compare to where we were for the last several years, and also compared to dividend-paying stocks. So, there's finally income and fixed income, and we think that the trajectory here will be flatter, more inverted yield curve as the Fed hikes, and investors should really take advantage of that.
Kathy, in terms of what the Fed needs to see in order to pull back and not be so aggressive with its rate hikes, certainly up for debate just in terms of whether we've seen peak inflation right now or what that could potentially look like over the coming months. What do you think is the 1 or 2 data points that the Fed needs to see in order for us to see the central bank ease in terms of its Fed policy at this point?
Yeah, I think the key would be a slowdown in wage growth. So there's a lot of focus on the low unemployment rate, the tightness in the labor market. Now, we're starting to see some indications it is loosening up, but I think they'd like to see that, employment cost index, which has been running north of 4%, start to ease down. Same with average hourly earnings. They'd like to see that kind of slow down and level off at a lower level. That would indicate that we're not getting wage pressure, and that would point to the likelihood of a slowdown in inflation with demand kind of easing back down to match up with where supply is. I think that's a key driver of Fed policy going forward.
Indeed. Kathy Jones from Charles Schwab on a huge day ahead. Appreciate your time. Thanks.